Hey everybody, Marty Mazura, After Hours Tuesday, 22nd of August 2023. Just a quick technical look at markets, the S&P 500, equity markets that is, the QQQ, the ETF that tracks the NASDAQ 100. I want to take a quick look at Apple and then look at Nvidia as well. Then I have a couple charts I want to show you from BCA's morning call this morning, and then one that we talked about internally here yesterday. So in front of you is the S&P 500 daily chart. The rising wedge pattern with real negative divergences played out as they tend to, and we've seen a decent pullback so far in August, falling right on what looks like pretty significant support right here at 43.25. Bounced off of that. But I'll tell you folks, still doesn't look very technically compelling. We did lose the 20-day moving average, as we've discussed, the bearishness in that, rising up and testing it and then having it roll over quite substantially. It's about to move below the 50-day moving average. Quite the distance still between here and the long-term 200-day moving average, which is a trend indicator that says this bullish trend is still intact until price drops below and the 200-day moving average flattens out and rolls over. We do think that probabilities lean in that direction before this cycle plays itself out. But of course, we remain open-minded to all possibilities. And you could argue right here on a real short-term basis that this looks very bear flaggy, if you will. I mean, that's just really how these things point. Of course, we have to break down below the lower line here for that to be a valid pattern. And if that were to break down, you would use the price target, the length of the flagpole, which would take us to down here, somewhere below 43.25, not too far, but it would be butting up against what again looks like a pretty important area here, a little below this in terms of resistance for a long time, and then briefly here support. So if indeed this market is heavy and it ultimately is going to trend downward, which we think is certainly within the realm of possibilities, if not probabilities, well then, kind of a flagging down over a period of time would make a lot of sense. Let's say we get great news from Nvidia again tomorrow and we move and retrace more of this decline right here, then we'd be looking at, a bigger bear flag pattern perhaps if we did break down, and that price target would be pushing down here around that probably 4100, 4135 mark. And again, lots and lots of action here. So bulls and the bears did a lot of battling here in these areas. So if indeed we're ultimately going to traverse our way down to test the bear market low or below in a recessionary scenario, it won't come in one straight line, I can assure you. There'll be a lot of choppiness, a lot of dip buying back and forth and so on. Otherwise, if, let's say in the near term, you get another massive beat from Nvidia, which some are anticipating, and I'll talk more about Nvidia in a second, or Nvidia, however you pronounce that, and something special in terms of friendliness for markets from Jerome Powell at the Jackson Hole conference this Friday, then certainly we could push even closer to these all-time highs that were established in January of 2022 for the S&P. Right now, again, our general conditions assessment is not bullish right now, and the technicals aren't bullish right now either, at least certainly looking at the daily chart. As for the NASDAQ 100, or the ETF that tracks it, similar action in here. It looks like this could very well be a classic bear flag pattern that would take us down roughly to 340 on the NASDAQ 100 index, or on this particular ETF. Not a lot of support below that if we break that area. Not even a lot of support there, technically speaking, frankly. As I've suggested all along, this one looks, for the equity market, if not one of the most concerning charts. Again, we had this bear market highs right in here against what we view as bearish patterns, against very definite bearish divergences, and broke down accordingly. So we'll see. Again, big earnings tomorrow. Nvidia has a lot to do from this area forward with how well the market has done as people raced in to AI stocks. And keep in mind that while the breadth has broadened, and that's been encouraging of late, nearly half of the S&P 500 companies are in negative territory. And per my update yesterday on results across asset classes, etc., 5 of the 11 major U.S. sectors are negative on the year still as well. So it's been anything but a robust, all boats rising with the tide kind of market, and that's a red flag in terms of what's left in the current investing cycle. We've been looking a lot at Apple lately. I drew, what some might consider a bear flag pattern right here. Could be more classic if we actually moved back up counter trend a little bit. But if indeed that was the pattern, we'd be coming down here, and you can see that just above 170 buyers have come back in of late. So we'll see. We'll see how that plays out. Again, I can get flaggy with this as well. The rest of this week's going to be big. I think a lot of people are not expecting much out of Jerome Powell. Analysts that I listen to and respect don't see anything earth-shattering on Friday. A couple articles from Nick Timmeros of the Wall Street Journal. He is viewed as someone who the Fed feeds information that they want to get public before they surprise anyone. Is suggesting that there will be some hints that interest rates are going to stay higher for longer, and that the Fed is actually going to ratchet up what they view to be realistic long-term projections for interest rates, real interest rates in particular. So we'll see. I see room for Powell to perhaps disappoint markets along the lines of what I just suggested. But then again, he could point to other disinflationary trends of late, and you could see the market rally on that. It may very well be, as I suggested, people I respect are anticipating that it'll be a nothing burger and we'll just move on into whatever the rest of August and September has in store. So that'll be interesting. As I mentioned, tomorrow, Nvidia announces its earnings. The stock was up a ton yesterday. It was down a good chunk of that today. We've heard estimates of just massive profit growth. Folks, when you look at valuations, it is so far off the chart of any sort of accepted norm for stock valuations. It's very reminiscent of the bubbly internet situation back in the late 90s, early 2000s. But, it is what it is. Stocks will trade relative to what people are willing to pay. I'm curious as to who's buying this stock at these multiples. I do think it's investing of a very short-term nature, maybe a lot of retail money rushing into it and pushing the price higher. When we look at it technically, it fell apart here a bit, nothing major, but this was just really classic the way we look at it, or was a classic bear setup. Very stark momentum divergences while the price was trying to melt a little bit higher. Broke down out of that, retested this line, broke down again. But with yesterday's big move, attempted to recapture this high right here, failed that noticeably today. And if we do capture that tomorrow, there's no way the momentum indicators are going to support that from a technical perspective. The minute it begins to roll over, we're going to have some pretty stark bearish divergences there as well. And then, of course, if they disappoint, if they don't give the market, or as a lot of companies are doing, not all of them, but a lot of companies are beginning to really scale down their forward outlooks, well then we have a whole other story to talk about. Nvidia is very interesting in terms of this craze in their direction because they're the big dog with regard to AI chips. When we look at where those chips are sourced in the world, who their biggest customers are in the world, and I think a relatively shallow moat in terms of the competition's ultimate ability to step up with processors that could work as well or even better. Nvidia is just fascinating to me. All the, I'll say, craze behind the stock. Not that it's not going to go a lot higher. We've seen stranger things happen. But at these multiples, it kind of dwarfs even Tesla in its heyday when everybody was screaming about its valuation. So time will tell. Going to be interesting for the rest of the week. Okay, just in closing, I mentioned a couple of charts I thought were interesting from BCA this morning. The first one here is the S&P 500 forward PE ratio. So they're based on next year's anticipated earnings. Okay. And then we have the 10-year TIPS yield inverted, meaning typically these two things go in opposite directions, but you invert one of them to show the correlation. And as you can see, they've been going dramatically away from their normal relationship here of late. So essentially it says that stocks have suddenly decoupled from the kind of indicators that would typically give you a sense for the direction that they should be going or that they would normally go. And then there's this thing called the equity risk premium. You'll hear that term from time to time. The analyst at BCA who discussed this morning uses the S&P 12-month forward earnings yield and then inverts that less the 10-year TIPS yield and comes up with this equity risk premium, which you can see where that sits right now. And when you go back, I know this is a little blurry. This is just before the massive financial crisis of 2008. And this takes us back to the tech bubble popping era back in here as well. So folks, stocks, as I continue to stress in a variety of ways, really look not so great right here. So the setup is precarious. Doesn't mean that the skies can't clear at these levels and we may want to grab more exposure even without some big meltdown. But I think patience is key right here, certainly as long as our overall global macro assessment is what it is, the technicals are what they are, and valuations are what they are. And then lastly, I thought this was an interesting one to share with you. Yesterday internally, Nick and I were talking about, I can't recall if it was about treasuries or QQQ or both, but I hope you can see this. There's a faint blue line. I just threw this chart up really quick for our conversation. And the blue line is the QQQ, the ETF that we track every week, or we have for quite some time now. The white line is the price of TLT, the long-term Treasury ETF that is widely used. So Treasury bond prices, or the ETF, is going to go down when interest rates go up. And so you can see that it's been trending lower of late. And notice, though, the correlation that well, to a different degree, but pretty closely correlated. As TLT does well, meaning interest rates come down, QQQ tends to go up. Tech stocks, which are prominent in this index, are very sensitive to interest rates. And here we are massively decoupling from that. Okay, and again, this speaks to, I think, the AI craze and so forth. While the overall, economic or macro or however you want to say that setup suggests that actually, this maybe shouldn't be happening. You can see here of late, it did kind of succumb to higher interest rates, and perhaps the concern over not so robust earnings, or not like we've seen here going forward. So folks, there's lots we can talk about. We can talk about the excess savings or the pandemic savings being spent down over the next few months, student loan payments picking back up again, all that macro stuff that we'll address when we do our economic updates. But again, right now, I'd love nothing more than to be bullish and tell you skies are clear and we should go for it. But that would be irresponsible, to put it mildly, under present overall conditions. Not all of it's bad. There's certainly good. I showed you a little bit of good in retail sales here lately. But when you weigh the evidence, what it says is that the risk of a storm is too high to not bring an umbrella, right, or hedge in some way, shape, or form, be it through diversification, hedging with options, what have you. So folks, I will leave it there. Oh, and by the way, this is the last blog post for this week. I will be scoring our economic index over the weekend, late in the weekend, and then present to you Monday morning, either like I did this week, just on the written blog, or maybe shoot you a quick video. Thank you as always for watching and listening, and I'll talk to you again soon. Bye-bye.